Imagine a world where the concept of money doesn't exist, where people trade goods and services based on mutual trust and community relationships. Now fast forward to today's world, where debt rules every aspect of our lives, shaping economies and influencing the destinies of nations. This transformation, spanning over 5,000 years, is a story filled with intrigue, power struggles, and moral dilemmas. Welcome to The Hidden History of Debt, Unveiling the Secrets of Our Economic Past, inspired by David Graeber's groundbreaking book, Debt, the First 5,000 Years. Join us on this captivating journey through time as we uncover the secrets of debt, revealing how it has molded our societies and continues to influence our lives in ways we might never have imagined. In the beginning, human societies operated without the concept of money. People lived in small, tightly knit communities where trust and mutual aid were the primary means of exchange. These early societies functioned through a system of barter and reciprocity, where goods and services were traded based on immediate needs and long-term social obligations. Barter systems, however, were not as prevalent as we might imagine. Direct exchanges of goods for other goods were limited due to the double coincidence of wants, the unlikely scenario where two parties each have something the other wants. Instead, most early transactions were based on extended forms of reciprocity and credit. For instance, if a farmer needed help during the harvest, neighbors would assist without expecting immediate compensation. The understanding was that the favor would be returned in the future. This form of credit was deeply embedded in social relationships and carried moral weight. A failure to reciprocate could damage one's reputation and social standing. Anthropologists have found that these early credit systems were widespread across various cultures. For example, among the Trobriand Islanders in the Pacific, the Kula ring facilitated exchanges of valuable shell necklaces and armbands. These items were not directly bartered for other goods, but circulated among the islands as symbols of social relationships and obligations. In such societies, the concept of debt was more about maintaining social harmony than about financial transactions. Debt represented a bond between individuals, a commitment to mutual support. This perspective on debt as a moral obligation rather than a financial burden persisted for millennia, even as societies grew more complex. As communities expanded and trade networks extended beyond local regions, the limitations of pure reciprocity became apparent. There was a growing need for a standardized medium of exchange that could facilitate trade between strangers. This need led to the emergence of money, which fundamentally transformed the nature of debt. The advent of money marked a significant shift in human economic systems. Early forms of money were not the coins and bills we use today, but items of intrinsic or symbolic value such as shells, beads, livestock, or precious metals. These items served as a standardized medium of exchange, making trade more efficient and less reliant on personal trust. The introduction of money allowed for more complex economic transactions. People could now engage in trade with strangers, knowing that the money received could be used to purchase goods and services from others. This shift facilitated the growth of markets and the expansion of trade networks. Money also transformed the concept of debt. Previously, debt was a personal obligation based on mutual trust and social bonds. With the advent of money, debt became quantifiable and transferable. A loan could be expressed in terms of a specific amount of money, which could then be repaid or transferred to another party. One of the earliest recorded uses of money and formal credit systems was in Mesopotamia around 3000 BCE. The Sumerians developed a sophisticated system of recording debts and credits on clay tablets. These records allowed for the tracking of financial transactions and the enforcement of repayment obligations. Interest, the practice of charging extra for the use of borrowed money, emerged alongside these early credit systems. Charging interest provided an incentive for lending and a mechanism for lenders to profit from their loans. However, it also introduced new complexities and power dynamics into the concept of debt. interest transformed debt from a simple obligation to repay what was borrowed into a more burdensome and potentially exploitative arrangement. Borrowers not only had to repay the principal amount, but also an additional sum, which could significantly increase their financial burden. The rise of money and interest fundamentally changed social and economic relationships. While it facilitated greater economic growth and trade, it also led to new forms of inequality and exploitation. Wealth began to accumulate in the hands of those who could lend money at interest, while borrowers often found themselves trapped in cycles of debt. As human societies continued to evolve, the use of money and credit became more formalized and institutionalized. The development of formal financial institutions and the codification of debt laws marked a significant transformation in the way debt was managed and perceived. In ancient civilizations like Mesopotamia, Egypt, and Greece, temples and palaces often functioned as early financial institutions. They provided loans to citizens, facilitated trade, and collected taxes. These institutions kept detailed records of financial transactions, ensuring that debts were tracked and repaid. The legal codification of debt also became more common. Ancient legal codes, such as the Code of Hammurabi in Babylon, circa 1754 BCE, included detailed regulations regarding loans, interest rates, and debt repayment. These laws aimed to standardize financial practices and protect both lenders and borrowers. One notable aspect of ancient debt systems was the concept of debt forgiveness or amnesty. In Mesopotamia, new rulers often declared a clean slate or amnesty, canceling all debts as a way to gain popular support and restore social harmony. These periodic debt cancellations were seen as necessary to prevent social unrest and economic stagnation caused by excessive debt burdens. In ancient Israel, the idea of the Jubilee was introduced as part of religious law. Every 50 years, all debts were to be forgiven, and land that had been sold to repay debts was to be returned to its original owners. This radical concept aimed to prevent the accumulation of debt and the resulting social inequalities. The institutionalization of debt and the development of formal credit systems brought both benefits and challenges. On one hand, they facilitated economic growth and the expansion of trade. On the other hand, they introduced new forms of inequality and exploitation, as those with the means to lend money could accumulate wealth and power. The rise of credit also had significant implications for social and moral perceptions of debt. In many cultures, failing to repay a debt was seen as a serious moral failing, reflecting poorly on one's character. This moral dimension of debt continues to influence attitudes towards debt and financial responsibility today. Debt has always been a powerful tool for exerting control and influence. Throughout history, rulers, governments, and powerful institutions have used debt to maintain their dominance and extract resources from their subjects or rivals. In ancient civilizations, rulers often used debt to exert control over their subjects. Temples and palaces, which functioned as both religious and financial institutions, provided loans to citizens and expected repayment with interest. This dual role gave rulers significant control over the economy and the people. Debt was also used as a tool of conquest and subjugation. Victorious armies would impose heavy debts on the defeated, forcing them into economic servitude. This practice ensured that the conquered territories remained economically dependent on the victors and provided a steady stream of resources. One of the most striking examples of debt as a tool of power is the story of the Jubilee in ancient Israel. The Jubilee was a radical concept introduced as part of religious law, which mandated the forgiveness of all debts every 50 years. This practice was intended to prevent the accumulation of debt and the resulting social inequalities. The Jubilee recognized that excessive debt could lead to long-term economic and social subjugation. By periodically canceling all debts, it aimed to reset the economic system and restore social harmony. This idea was revolutionary, as it challenged the power dynamics inherent in debt-based economies. In medieval Europe, The Catholic Church's prohibition of usury, the practice of charging interest on loans, was another example of debt being regulated for moral and social reasons. The Church viewed usury as morally wrong and economically harmful, as it allowed lenders to profit from the misfortune of others. However, the prohibition of usury did not eliminate the need for credit. Instead, it led to the development of alternative financial instruments and practices. Merchants, for example, engaged in complex trade agreements that effectively allowed them to charge interest without violating religious prohibitions. Debt has also been used as a tool of social control in more recent history. During the colonial era, European powers imposed heavy debts on their colonies, forcing them to produce cash crops and other goods for export to repay their debts. This practice ensured that the colonies remained economically dependent on their colonizers and provided a steady stream of resources to the colonial powers. In the modern era, debt continues to be a powerful tool for exerting control. Governments and financial institutions use debt to influence economic policies and behaviors. For example, international financial institutions like the International Monetary Fund, IMF, and the World Bank provide loans to developing countries, but often impose strict economic conditions as part of their lending agreements. These conditions, known as structural adjustment programs, typically require countries to implement austerity measures, privatize public services, and liberalize their economies. While these measures are intended to promote economic growth and stability, they often result in significant social and economic hardships for the borrowing countries. Debt is also used as a tool of control at the individual level. In many modern societies, access to credit is essential for economic participation. However, excessive debt can lead to financial distress and social marginalization. Those who are unable to repay their debts may face legal consequences, damage to their credit ratings, and limited access to future credit. The power dynamics inherent in debt relationships have significant implications for social and economic inequality. Those with the means to lend money can accumulate wealth and influence, while those who rely on borrowing are often at a disadvantage. This dynamic reinforces existing social hierarchies and can perpetuate cycles of poverty and inequality. Debt has always been more than just a financial arrangement. It carries significant moral and ethical implications. Throughout history, societies have grappled with the moral dimensions of debt, balancing the need for credit and economic growth with concerns about fairness, justice, and social stability. In many cultures, debt has been viewed as a moral obligation as much as a financial one. Failing to repay a debt was often seen as a serious moral failing, reflecting poorly on one's character and honor. This moral perspective on debt is deeply embedded in religious and philosophical teachings. In medieval Europe, the Catholic Church played a significant role in shaping attitudes towards debt and usury. The Church prohibited usury, the practice of charging interest on loans based on the belief that it was morally wrong to profit from someone else's need. This prohibition was rooted in biblical teachings and the belief that lending should be an act of charity rather than a means of profit. The Church's stance on usury had significant economic implications. It limited the ability of individuals and institutions to lend money at interest, which in turn influenced the development of financial systems. Despite the prohibition, the demand for credit persisted, leading to the creation of alternative financial instruments and practices that skirted the boundaries of usury laws. In the Islamic world, similar prohibitions on interest are found in Sharia law. Islamic finance principles prohibit riba, interest, and emphasize risk-sharing and ethical investment. Islamic banking and finance have developed a range of financial products that comply with these principles, offering alternatives to conventional interest-based lending. The moral economy of debt is not confined to religious teachings. Secular philosophers and economists have also grappled with the ethical dimensions of debt. For example, the 18th century Scottish philosopher Adam Smith often considered the father of modern economics, recognized the potential for debt to create social and economic imbalances. Smith argued that debt could lead to economic instability and moral corruption if not properly managed. He warned that excessive debt could result in financial crises as borrowers become unable to repay their obligations and lenders face significant losses. Smith's insights remain relevant today as the global economy continues to grapple with the consequences of excessive debt. In modern times, the concept of bankruptcy reflects the moral and ethical considerations surrounding debt. Bankruptcy laws allow individuals and businesses to discharge unmanageable debts and start anew, recognizing that perpetual debt can be both economically and morally untenable. These laws aim to balance the interests of creditors and debtors, providing a mechanism for resolving financial distress while protecting basic human dignity. The moral dimensions of debt are also evident in contemporary debates over student loans, payday lending, and sovereign debt. In the United States, the student loan crisis has raised ethical questions about the fairness and sustainability of financing higher education through debt. Critics argue that the burden of student loans disproportionately affects lower-income students and perpetuates economic inequality. Payday lending, which involves short-term, high-interest loans to individuals in financial distress, has also come under scrutiny for its predatory practices. Critics argue that payday lenders exploit vulnerable borrowers, trapping them in cycles of debt with exorbitant interest rates and fees. Efforts to regulate payday lending reflect ongoing concerns about the ethical implications of high-cost credit. Sovereign debt, the debt of national governments, presents its own set of moral and ethical challenges. Countries that accumulate excessive debt may face economic and social hardships as they struggle to meet their repayment obligations. International financial institutions, such as the IMF and the World Bank, often impose stringent conditions on borrowing countries, raising questions about the fairness and impact of these measures. Debt forgiveness initiatives, such as the Heavily Indebted Poor Countries (HIPC) initiative, aim to address the moral and ethical dimensions of sovereign debt. These programs provide debt relief to the world's poorest countries, recognizing that excessive debt burdens can hinder development and exacerbate poverty. By reducing debt, these initiatives seek to promote economic growth and social stability. The moral economy of debt continues to evolve, reflecting changing attitudes and values. In recent years, there has been a growing recognition of the need for ethical and responsible lending practices. Financial institutions and policymakers are increasingly focused on promoting financial inclusion, protecting consumers from predatory lending, and ensuring that debt is sustainable and manageable. The ethical considerations surrounding debt also extend to the broader question of economic justice. Advocates for economic justice argue that debt should not be a tool for exploitation or oppression, but rather a means of promoting equitable growth and shared prosperity. This perspective calls for a reevaluation of financial systems and practices to ensure that they serve the common good. The modern era has witnessed the rise of global capitalism, a system in which debt plays a central and increasingly complex role. Today, debt is not just a personal or national issue. It is a global phenomenon that affects every aspect of our lives. From consumer credit to sovereign debt, the modern financial system is deeply intertwined with the dynamics of borrowing and lending. One of the most significant developments in the modern era is the rise of consumer debt. Credit cards, mortgages, auto loans, and student loans have become ubiquitous, allowing people to borrow money for a wide range of purposes. This access to credit has fueled economic growth and enabled individuals to improve their standard of living. However, it has also led to unprecedented levels of personal debt. Consumer debt has transformed the way people live and work. It has made it possible for individuals to purchase homes, cars, and education, often with the expectation that they will repay their debts over time through future earnings. While this access to credit has democratized consumption and investment, it has also created significant financial vulnerabilities. The rise of consumer debt has been accompanied by the development of sophisticated financial instruments and markets. Securitization, the process of pooling and repackaging loans into tradable securities, has become a cornerstone of modern finance. Mortgage-backed securities, for example, allow lenders to sell loans to investors, spreading the risk of default and providing additional capital for lending. While securitization has increased the availability of credit, it has also introduced new risks and complexities. The 2008 financial crisis, triggered by the collapse of the housing market in the United States, highlighted the dangers of excessive and poorly regulated debt. The crisis revealed how interconnected and fragile the global financial system had become, as the failure of mortgage-backed securities led to a cascade of bankruptcies and economic turmoil. In addition to consumer debt, national and corporate debt have also grown to unprecedented levels. Governments borrow money to finance everything from infrastructure projects to social programs, often running deficits to stimulate economic growth. This borrowing is typically financed through the issuance of government bonds, which are purchased by investors seeking stable returns. Corporate debt, meanwhile, has become a key tool for business expansion and investment. Companies issue bonds and take out loans to finance mergers, acquisitions, research and development, and other activities. The availability of cheap credit has enabled companies to grow rapidly, but it has also increased their financial leverage and vulnerability to economic downturns. The rise of global capitalism has led to the creation of complex financial markets and institutions that facilitate the flow of capital across borders. International banks, investment firms, and financial intermediaries play a crucial role in the global economy, providing liquidity, managing risk, and enabling investment. These institutions operate within a regulatory framework that varies from country to country, adding to the complexity of the global financial system. One of the defining features of modern capitalism is the dominance of financial markets. Financialization, the process by which financial markets, institutions, and instruments become increasingly central to economic life, has transformed the way businesses and individuals operate. The pursuit of financial returns has become a primary driver of economic activity, influencing corporate strategies, government policies, and individual behavior. Financialization has led to the growth of speculative activities, such as trading in derivatives and other financial instruments, which can generate significant profits but also pose substantial risks. The focus on short-term financial gains has sometimes come at the expense of long-term investment in productive assets, contributing to economic instability and inequality. The modern era has also seen the rise of sovereign debt as a critical issue in global finance. Countries around the world borrow money to finance their budgets, often accumulating substantial debt burdens. Sovereign debt crises, such as those experienced by Greece and Argentina, can have devastating economic and social consequences, leading to austerity measures, economic contraction, and social unrest. International financial institutions, such as the IMF and the World Bank, play a crucial role in managing sovereign debt. They provide loans to countries in financial distress, often imposing conditions that require structural reforms and fiscal austerity. While these measures are intended to restore economic stability, they can also lead to significant hardships for the affected populations. The COVID-19 pandemic has further exacerbated global debt levels as governments, businesses, and individuals have borrowed extensively to cope with the economic impact of the crisis. The pandemic has highlighted the vulnerabilities of a debt-dependent system and raised questions about the sustainability of current debt levels. As we look to the future, the management of debt will be a critical challenge for policymakers, financial institutions, and individuals. Addressing the risks and inequalities associated with debt will require innovative solutions and a commitment to building a more resilient and equitable financial system. As we navigate the complexities of the modern financial system, it is crucial to address the challenges and opportunities presented by debt. David Graeber's Debt, The First 5,000 Years, offers valuable insights into the historical and moral dimensions of debt, challenging us to rethink our relationship with debt and credit. The COVID-19 pandemic has highlighted the vulnerabilities of a debt-dependent system, prompting a reevaluation of how we manage debt at all levels. The pandemic has led to unprecedented levels of borrowing by governments, businesses, and individuals, raising concerns about the sustainability of current debt levels and the potential for future financial crises. One potential solution to the challenges of debt is the concept of debt forgiveness. The idea of debt forgiveness has deep historical roots, as seen in the ancient practice of the Jubilee. While forgiving all debts may not be practical in the modern world, targeted debt relief programs could help alleviate the burden on the most vulnerable individuals and communities. Debt forgiveness initiatives, such as those aimed at relieving the debt of developing countries, have shown that reducing debt burdens can promote economic growth and social stability. By addressing unsustainable debt levels, these programs help countries invest in essential services,